While the markets are flashing red today, what if I flipped your worldview and said the risk isn't some far off recession, but in fact it's the obscene valuations that are bloating your portfolio that are about to wipe out 10 to 20% of your nest egg in a matter of months? Because right now, Wall Street CEOs and legendary hedge fund manager Michael Burry are all sounding the alarm. They're saying we're facing an imminent pullback, a massive correction in this over-leveraged, liquidity-drained market. And what it's about to do is send stocks, gold, and crypto all crashing. Now, the smart money, they're already betting against it. Now, stick around because I'm going to expose why. It's time to get out now, and more importantly, what you can do to safeguard your future right now. Because Wall Street's top CEOs are flashing red alerts that a major market correction is coming soon as they flag high market valuations as a major risk. Now, at the heart of this mess, we've got strong corporate earnings are getting overshadowed by nosebleed prices. And take this from Mike Gitlin. He's the CEO of Capital Group. He says corporate earnings are strong, but what's challenging are valuations. And he's 100% right here, because what's happened is investors have continued to push price so high that valuations aren't keeping pace. And the risk is we already know that valuations are about to get a whole lot worse. Because when you understand where imports go, well, corporate profits inevitably follow. And right now, with the global economy grinding to a halt amid trade wars and slowdowns, profit margins for countless companies, they're already flipping negative. And what that's doing, it's going to put a death knell on overpriced stocks. Now, don't just take my word. Let's pull up some proof here. Let's take a look at corporate profits after tax, as shown in blue. It's the imports of goods and services, because I want you to see this from the macro view. And I want you to understand very clearly that corporate profits follow imports. But what's the risk we're facing right now? You can clearly see that corporate profits have turned negative. Imports are already set to go negative, meaning it's going to drive profit margins further down. And this is looking back at Q2. So if they've already nosedive in the red last quarter and imports collapsing even further, you can expect steeper drops in the market to come. And echoing Gitlin are heavyweights like Morgan Stanley CEO Ted Pick and Goldman Sachs Group's David Solomon, who also see the possibility of a significant sell-off in the coming period, and said that pullbacks are a normal future and healthy for market cycles. But hold up here. Because remember those endless earning beats we talked about, where analysts, they just lowballed expectations to lure in cash, and everybody saw that markets were beating expectations? I warned you then that it was a trap, and sure enough, you're seeing it now. Because all Wall Street did was pump valuations to historic highs in an eager bid to sell stocks to retail investors. And now what they're doing is they're flipping the script, and what we're seeing is they're looking to cash in on the downside move. Because Wall Street's been unloading while you've been buying. And now they're positioning for a massive rug pull. Now let's take a look at some numbers here, because the S&P 500 was trading at 23 times forward earnings estimates. That's above its 5-year average of 20 times. How about the NASDAQ? Well, not to be outdone, it's trading a multiple of 28 times compared with nearly 19 times looking back to 2022. So what we're facing right now is investors are chasing prices higher purely on momentum. Has nothing to do with fundamentals. All they're seeing is stocks are going up, and you got to be in it to win it. Now, you've probably heard the phrase that earnings don't matter until they do. Well, all of a sudden, they're about to matter in a big way, because they don't matter when retail is piling in and buying stocks at ridiculous valuations. But watch, all of a sudden, in the quarters to come, they're going to matter big time when Wall Street decides it's downturn o'clock. Now, in the quarters ahead, profits we already know are going to be cratering. We know companies are getting squeezed at the margin. And what that means, stock prices are likely to follow. Now, here's the hard evidence. Let's take a look at this chart of corporate profits after tax against the NASDAQ 100. That now in red. We've got them both on a year-over-year rate of change. And I want to specifically take a look at a couple points here. One of them going into the dot-com bubble. You can see on a year-over-year rate change, the NASDAQ was surging higher. That was the tech bubble. And look what happened. Corporate profits went negative. We see the same thing going into the global financial crisis. And now we're facing the same setup. We know corporate profits likely to continue to go down over the coming quarters. Right now, stocks showing they're massively overvalued. And while the markets are flashing red, my subscribers are seeing green, and you can too. We told them on the open yesterday to buy right here at this green candlestick, and look, in 2 days this thing is shooting higher and set to go up even more. Now, how did we do this? Well, this came from our new optimized trades. This from our CTA Timer Pro report. Again, as of yesterday, in 1 day, the trade up almost 3%. Now, how did we have this edge when it comes to trading against machines? Because I've optimized my entire report on a per security basis. We know where our winners at, and we know the data. Check this out, because when we pulled our subscribers, we said this has got a win rate of 41%, average expected positive return over 12%. And all that told us, let's keep our stops tight, and we're going to keep raising them along the way. We make this so easy for you to make money. All you have to do is grab those links in the description below, hit the coupon code for your free 30-day trial, and while you're there, there's a full video walks you through exactly how we trade and how you can make money in these markets no matter which direction they go. And this is a big issue because markets are most irrational at the heights of a bull market and at the depths of a bear market. This from Citadel Chief Executive Officer Ken Griffin, who added that we're, quote, now very deep into a bull market. But it's not the market that's crazy. It's us investors who keep buying because we're hooked on some delusion that prices are just going to keep going up forever and ever. This setup, well, as you're about to see, is priming a brutal wake-up call, one that could send many asset classes crashing. Now let's start off with a poster child for the hype. That's Palantir, whose stock is up a massive 150% this year, but fell hard this morning even after the company raised its revenue outlook and beat estimates for third quarter sales. So why would there be a bloodbath? Because that's great news. What's the problem here? Is its price to sales ratio ballooned to nearly 85. That's the loftiest in the S&P 500. Nobody's even near him. And what it's telling the market, it's completely unsustainable, particularly for a market right now that's looking to burst some bubbles. Now, adding to the unease, hedge fund manager Michael Burry disclosed some bearish wagers on Palantir and Nvidia. In his latest 13F filing, he reveals that 80% of his portfolio is in puts against Palantir. That's about 912 million notational. And Nvidia, well, he's got 186 billion in notational bets against. So together, he's saying this AI hype, it's about to collapse. Now, the problem is, even though he was very early in the housing bubble, right now investors fear that he's going to be spot on again. And if he's right, that these shorts could amplify a massive tech rout. But the real accelerator, well, it's momentum chasing machines like CTAs. And we warned about these. When we see prices start to go down, well, what they do is they cut and run and they dump stocks en masse. And right now, my friends, they are primed to sell. Because according to Goldman, CTA sellers in every scenario, but could be offset by return of buybacks. We'll hang tight on that. CTAs will continue to be modest sellers in every market scenario over a 1 week horizon. But the levels to watch, write this down, 66.72 on the S&P. That's your short-term threshold. But things can unwind much bigger over the next month, particularly if we face a correction around 10 to 15%. I'm going to show you why it's going to get much worse. Because in a down tape, the CTAs, they're going to be selling 205.3 billion of global equities over a month. That's 67.2 billion out of U.S. equities alone. So what we're facing here is the CTAs would accelerate any move down, particularly in a liquidity-starved market. Now, what does that mean? It means there aren't enough buyers to offset all the sellers. But one thing that everybody's hoping will be the biggest buyer, well, that's the corporate buyback window, which is now looking to ramp up to around 5 billion a day, according to Goldman, as we move into the Q4 open window. And we're in the final open window of the year, which is estimated to continue from today through 12/19. And as of today, we estimate about 40% of the S&P are in the open window, with 60% in the open window by the end of the week. But if CEOs right now are blaring valuation alarms, what is that telling you? That they're done selling too. So what we're facing here is they're giving you an early warning that a storm is coming. And that means they're about to pull the rug on their buyback machine as well. So what we're facing here is a potential mismatch that leaves markets vulnerable, especially amidst a liquidity crunch. And that hasn't gotten any better. Let's take a look at the repo markets, because on Friday, the SOFR rates rose 32 basis points above the IORB, and that's the widest it's been since 2020. before dropping down to 4.13% on Monday. It still remains above the IORB, currently at 3.9%, and that is a problem because remember, the Fed just cut rates. So what we're still seeing here are banks looking to the Fed to get cash because the repo markets aren't providing it. This is exactly what happens when liquidity dries up. And for markets, you need liquidity because when people sell, you want buyers to step in. The problem is, if buyers can't get cash or borrow money, well, they're not going to be there. So what this signals is banks could rein in margin debt. So it'd be a huge problem, particularly for a market that's over leveraged in this long extended rally that could lead to fire sales like we just saw in the crypto market not too long ago. And for small investors, could be a wipeout event. Now, at the core of all this, and I've warned about this, is the dollar's reversal. And after weakening all year, fueling borrowers to chase stocks, gold, and crypto, the DXY, well, it's starting to rally pretty hard here. Now, keep in mind, everybody was either shorting the dollar, selling the dollar, or borrowing against it to buy other asset classes, and now it's on the edge of a spectacular unwind fueled by sky-high valuations. And for crypto, my friends, let's take a look because it could be the leading indicator of more pain to come for the markets. As Bitcoin now falls to the lowest since June as risk-off mood hits crypto, and I want you to be thinking how this is all connected because it's happening at the same time the dollar is rallying. And when did the dollar start to head higher? Well, let's look back. It's pretty easy to see. It was late June. And Bitcoin, often seen as a proxy for speculative momentum, is once again falling step in step with equity sentiment. So what we're facing right here, my friends, is CEOs are warning. Liquidity is evaporating. Burry has gone short. Crypto is foreshadowing tech pain. Machines are poised to sell. And the dollar is powering up, just as I warned it would. This won't be your garden variety dip. It's a setup for a vicious pullback. And what it is, it's an urgent call for you to protect yourself before it's too late. So we've gone through the perfect storm and you can see it's starting to build and accelerate. We've looked at bloated valuations. They're going to explode like grenades inside portfolios. Smart money like Burry shorting the AI hype. CTA set to dump $205 billion of global equities. You've got liquidity issues that are still showing up at the Fed. We can see it in the SOFR rates. The dollar is rallying and that's crushing crypto, threatening to take gold and tech with it. And what this is, again, is setting up for a massive correction in the markets. But here's the game-changing climax, my friends. This isn't doomsday. It's your contrarian edge to flip the script and outsmart Wall Street before the herd stampedes. Because if you can protect yourself now, you can be coming back in at that bottom and buy. And that is the payoff because I want you to shift your perspectives now. Think about diversifying into value. Put dollars in your portfolio. We've been talking about this for weeks. It's not too late. How about treasuries? Remember, they followed the Fed, particularly on the front intermediate end of the curve, and the market's still pricing in December rate cut. And if the market goes down, those odds will increase. And how about gold? Well, remember, the second rate cut is bearish, so look to buy the major dips, not the minor. And if you've got some long-term crypto holdings, it's time to put some hedges on. If you're a trader, maybe it's time to get out. And if you're trading with leverage of any kind in any way, it's time to cut it before it's too late. Don't let Wall Street pull your rug. Act today and secure tomorrow. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.